Now I want to ask you, isn't these methods of selling 500 points away or the methods which we discussed, isn't that a very old way of trading? And if you follow the old methods, how is it working for you? Hi everybody, welcome to the video. How to pick the strike, especially when you're making a credit strategy. How many times it happened that you are so confused, there has to be a proper written solid method when you trade into the options. So today we're gonna address your number one issue. I'm gonna give you insights on this. Before I start, I have to tell you standard disclaimer: any method, any option strategy ever which you see contains a certain amount of risk. The strategy and the method explained is for educational purpose. Now, before I tell you the solution, the method which is properly backed by data, I want to tell you what is the retail method of picking the strike. If you want to sell a short strangle, imagine what is the method. Let me take you through what do maximum people do. So here we are on an option chain, if you can see, and I've selected the monthly. Now the number one thing how people do is that suppose market currently is trading at 25,300. Now a lot of people try to sell a call and the put 500 points out of the money. Extremely popular. That's what people do. So it's 25,300. A lot of people will try to sell probably 24,800 or so on the call side, on the put side. Very, very popular. What is the logic of selling a 500 points up and down is something we ourselves have to ask ourselves, because it's easy. So that's why we do point number one. Point number two, other thing what maximum people do is, so they take out the range, and you have seen so many videos on YouTube, right? So what do they see is that they combine, this is call and the put. So call is trading at 258.7. assuming at the money. So we will just add the premium of at the money straddle. Again, very popular, 1.2.45. This is a put. So net is 401. Now, maximum retail traders, what they do is, oh, we've taken out the range. We've taken out the 1 sigma range. So let's just sell a call and the put. This can be extremely risky. Or number three method is look at the highest open interest, where the call is, where the put is, and look to sell option. Again, extremely risky. There has to be an edge in options trading, right? Now, obviously selling naked options is not recommended. So a lot of people do iron condor or other hedge strategy. This is the Nifty chart which you see on your screen. Every candle represents 1 day. Is there any method by which the data itself tell us which strike will have a higher probability? Not the certainty, it's a business, but a probability. Is there any way? Let's figure out the method number one. How do we decide which strike is beneficial? So let's learn top two method with the very strong logic, right? Method number one, the volatility method. Number one is go to TradingView or any other charting platform and look at the last 30 days of Nifty movement. Assuming that this is the start of the month and you're looking to take out the range, maybe you look for credit strategy, maybe you look for debit strategy. I'm not recommending you which strike you need to sell, but there has to be a line in the sand. Once you take out the 30 days Nifty range, take out the highest point and take out the lowest point. Easy, right? There are a lot of ways by which you can do volatility method. At least 5 methods are there, but I'm giving you the most easiest and the convenient method, right? Now calculate the range. Obviously how do you take out is highest minus the lowest, so that comes out to be the range, which comes out to be 1400 points, right? Simple maths. Now take out 50% of the range. The range is full, right? Up and down both. So this is your historical move. Why 50%? Because obviously, right, if the combined range is 1400, that means 50%. That means 700 points is your historical move. That is your range coming as per the data of Nifty, how it behaved in the past 30 days. Same way you can take out for 60 days, you can take out for 10 days, etc., etc., and so on. But obviously, the bigger the time range, the easier it is to calculate the range. Easy, right? Now let's go to the second thing, right? You have to share this video once you watch it, so a lot of people get benefit out of it. And the old way of selling options, which I told you, at least they're gonna get a better insight. Who's gonna tell them on YouTube? Hardly we see videos like this, right? Nobody goes so deeper. Anyways, back to the topic. Step number 2, once you take out the range, then you can look to go to option chain and find at the money strike. This is very important. At the money strike, note down the call premium and note down the put premium. Assuming that at the money call is 420, at the money put is 380. So at the money straddle, you add them, it comes out to be approximately 800 points. Now, this is a very popular concept that what people say is that if the at the money straddle, the combined premium of call and the put is a 1 sigma move. This is what the options pricing is telling us, that it's expected to be in the range 1 sigma. The real pricing, the current market pricing versus the historical range which you have taken out. So far, it's easy. Now, this 800 point is your implied move. We are not calculating and we are not guessing at all. We are just looking at the mismatch between the pricing when it comes to options trading. Maybe strangle. Let's see. So 800 is your implied move. That is what option pricing is suggesting us, that this much it's expected to move. Obviously, we're looking at the monthly option chain when the month is about to start. Now, we've got 2 strong data points, haven't we? Now, it's time for us to take out the edge. So, implied move minus historic move, right? So, the real edge is, example, I'm going to give you a good example. Implied move is 850, the straddle premium. This is the straddle premium. Historically, is 700. So, option is telling you that 850 is the straddle premium, 1 sigma move. Now, we don't have to just sell the option just blindly. We are just taking out some kind of a mismatch. And obviously, when we look to sell, we obviously want to sell when the current option pricing seems to be expensive, right? And when you buy, you look to buy when it's cheaper, right? Simple, very simple. That's how it is. Now, let's take out the other example. For example, the bad example. The implied move is 800 straddle premium, right? But the historic move was around 1100 minus 300 points. That means that the premium, the option premium, that is, trading at much lower. It's trading at minus 27.3. I want to leave that to your imagination. Or if the option pricing is lower, when it's suggesting you that it's not a right time to sell. Similar months. Now, the same way, 30 days, one can take out probably, 6 months and then look to calculate the range. You can do it probably 90 days as well. But it's recommended to go for higher time frame. It's much, much better. So we look to take out the higher range. Higher, the better. This was the method 1, how to select the strike, how to make it a little better, some kind of a data backed, logic backed. Now, I'm also thinking to tell you and give you the method number 2, right? If I make the video now, it's going to be very long video. I will tell you a sneak peek, right? You ready? Now, open option chain of your favorite index. Find out where 20 or 30 delta is, right? See the difference between the pricing of a 20 delta call and the 20 delta put. Why the difference is there? When the delta is same, the premium should be same. Why there is a mismatch in the premium? Any kind of a hint which market is giving us. Right? Sometimes market tells you with the data. If you go a little deep and expand your understanding, chances are that you may get a better method, a better insight. That is the exactly reason why I tell you that hit and trial, just trying based on gut feeling, that is something which one must completely avoid. One can always look to improve on the trading, probably get the better methods. Thanks for watching and I wish you all the very best. Take care. Bye-bye. Signing off.